Hi there, welcome to the part 6 of our video series on financial modeling and valuation analysis. In this particular video, we are coming to look at another supporting schedule called the operating working capital schedule. Alright, so welcome to my channel. This is the Gen Z Analyst. If this is your first time on my channel, please make sure you have subscribed to the channel and also make sure you have watched my previous videos. I've left a link to watch all of them, the past 5 videos, in the video description, so you can look at them and then watch them. Alright, so we are going to continue our discussion and we are going to build the working capital schedule, which is one of the 3 main working or supporting schedules we have when building a standardized financial model. Alright, so the working capital is important for our cash flow model or our cash flow statement modeling. So as you can see in our previous video on modeling the cash flow, we actually left the working capital items blank. So when you come to the cash flow statement, you could see that all of the historical portions of our working capital here has been left blank. So it is the working capital schedule that is going to help us to populate these empty spaces within our cash flow statement. All right. So with that said, let's get into business. So let's put some heading here. So I'm going to have working capital schedule, and this is in millions of US dollars. So I'm going to have USD in millions of USD. Then I'll put my dollar sign there. All right. And then I'm going to format this a little. So I'll have this bolded. Also match the cells there. Okay, I'll not merge it. I'm going to have this center across selection. So I'm going to expand this particular alignment options here. And I'll come to alignment, the horizontal. I'll select it and say center across selection. So I'll select that and hit OK. Alright, so that is what I'm going to have there. And also expand or increase the font size a little. And change the fill color to my favorite color, which is this green. So what I'm going to do is to go here and copy this. Come here and come and paste. Alright, so my writing is gone, so I'm going to retype the topic or the heading. So we have operating working capital schedule in US dollars millions. Let me select and do my center across selection. So expanding that, or you can also hit Control 1, or you can just expand that. Come to alignment, come to general, center across selection. I'll select that and hit OK. Alright, so that is what we are having there. And I'm going to expand and increase the font size as well. And also expand this a little. Put this at the middle. Alright. Okay, so that's what we have. And then I'm going to have my years. So I'm going back to my balance sheet and I'm going to copy this. the whole of this, copy, and come back to my working capital schedule, and I'm going to paste here. Or let me cut it and paste it here. Okay. Then I'm going to have a list of all my working capital items. Now, when we talk about working capital is simply current assets minus current liabilities. And so that means that the components of our working capital is current assets and current liabilities. So these two items put together are what we call working capital or operating working capital. Okay, now the word operating capital is very important because some current assets are not included within this particular schedule. These items include cash and cash equivalent, and I'm going to explain why it is not part of our working capital. We also have marketing securities. They are also not part of our working capital, and marketing securities are more or less cash equivalents, and so we do not include them within our working capital schedule. So take note of that. I'm going to explain those when we are dealing with our cash flow statements. So just take note of that. So with our current assets, we are talking about inventory. We have inventory, we have accounts receivable. All right, and I wanted to leave a space between them, so I'm going to paste it here, and then I can cut this and put it here. And then for our current liabilities, we're going to have accounts payable, we're going to have leave a space, we are going to have accrued expenses, leave a space, we are going to have an earned revenue. Okay, so these are the main working capital items that we are going to deal with as far as Amazon financial statements are concerned. Okay, now what are current assets? Current assets, as you can see, includes inventory and accounts, and these are assets which are expected to be used up or converted into money within 12 months or within one financial reporting period. All right, those are current assets. And then we have current liabilities. Now, these are liabilities that are expected to be paid or repaid within one financial reporting period. So that is within a 12 calendar month. All right, so that is the difference between these two items. Now, for our purpose, these are the compositions of our current liabilities as well. We have accounts payable, accrued expenses, and an earned revenue. So these are our working capital items. All right. Now, working capital can be positive or negative. And so at the end of the day, we are going to have our total. We're going to have our totals. So here, I'm going to have my total current liabilities. And then I'm also going to have my total, sorry. So this is supposed to be total assets. So I'll copy that and paste it here and change my liabilities here to assets. Okay, and I'm going to bold this, insert an extra space there, and also bolding this. All right, now working capital is a measure of how much cash or current resources are available to meet our short-term obligations when they become due. All right, so what you're saying is that if working capital at the end of the day is positive, then we are going to say that we have enough funds to cover our short-term liabilities when they fall due. All right, now the opposite is true when our working capital is negative, which means that our total current liabilities are exceeding our total current assets, and so we are at risk of liquidity. All right, so that is what we do. Now I'm going to delete these extra rows here. All right, so that's fine. And then this is what I'm going to do. Let me insert another one more. All right, so with the spaces we have left here, when it comes to working capital, we make use of what we call efficiency ratios. We calculate efficiency ratios to be able to, one, analyze the historical performance of our working capital items, and two, also forecast these working capital items. So we are going to calculate um, these efficiency ratios, and the efficiency ratios are calculated in days. All right, so we have inventory days. So I'm going to have inventory um, turnover days. I'm going to have accounts receivable days, accounts receivable days. And what I'm going to do is to shift this or increase the indent and also italize this. I'll do same for my inventory receivable days. So italize this and also increase the indents. All right. Then I'm going to do same for all of them. So accounts payable. Accounts payable is going to be our accounts payable days. We're going to have accounts payable days. I format that as an italic and also increase the indent. Accrued expenses is accrued expenses days. Okay, italize this and also increase the indent there. And then finally, I have my unearned revenue. So I have an earned revenue days. Right, so let me also format this as an italic and also increase the indent. Right, so we are making headway. So with this, we are going back to our balance sheet to pull the historical data from there. So I'm going to have my equals, go to my balance sheet and pull my inventories from there. And then I'm going to do same for my accounts receivable. So I will come here and pick my accounts receivable figure there as well. Do same for my accounts payable. So I'll come here, go back to my balance sheet and pull that. So that is the liability section. So accounts payable. Let me copy this. No. All right, then I'll also pull that of my accrued expenses. And lastly, I'm going to pick that of the unearned revenue. And then I'm going to select all of this, select it to there, and then I can copy it to the right using Control R. And that is going to populate that for me. All right. Okay. So we have that. Then I'm also going to format all of them as by bringing my comma with 0 decimal places. Sorry. And also adjust this. So I'm going to bring my comma with 0 decimal places. I'm going to do it for all of them. So then I can resize this now. All right. So we have put our historical data, we have edited it nicely. So let's calculate our inventory turnover days, accounts receivable days, and all that. So this is what you're going to have. Now, accounts inventory turnover days is calculated as our closing or the average inventory divided by our cost of sales, because inventory is a huge part of our cost of sales. And so inventory is modeled using our cost of sales. All right, so that take note of that. When it comes to accounts receivable, this is linked with revenue. And so we are going to project it using revenue. When it comes to our liabilities, most of them are going to be linked with our operating expenses as well as cost of sales. So take note of that. So when it comes to inventory, it is going to be equal to our historical figure, this particular figure here, divided by our cost of sales, which we can find within our income statement. So scroll back to my income statement and pick my cost of sales figure here, and I'll multiply the result by 360 days. Now, some people might use 365 days. That is not wrong, but 360 is divisible by 12, and so if you use 360 days, it's easy for you to convert your figures into monthly components. All right, so that's why it is advisable to use 360 days. You can use 365 days. That one is not a problem. In my previous videos or in my other videos, you could see that I used 365 days. That is also not wrong. All right, so they are all correct. Enter. I'm going to hit enter, and this is in days. So what I'm going to do is to reduce the so, so, so that is 43 days. I'm going to format this as an italic and also copy it to the right using Control R. All right, so that is our inventory turnover days. Now, I use the closing inventory figure here on our balance sheet. Others might also use the average inventory figure, which is actually correct. All right, that is more correct than using the closing inventory. If you want to know more about how we calculate these ratios, you can check out my videos on how to analyze financial ratios. All right, I have a host of videos on financial ratios analysis, so you can check those videos out. All right, Then we go to our accounts receivable days. So that is going to be equal to our closing receivable days divided by, so as I said, receivable is associated with revenue. So we are going to divide it by our total revenue figure, here, and I'm going to multiply the result by 360 days. So that is 25.2. Format is to 0 decimal places. Format it as an italic and copy it to the right using Ctrl R. Alright. Then we also have um, our accounts payable days. So the accounts payable is also calculated as the closing accounts payable divided by our cost of sales. Now remember, accounts payable is associated with purchases, and so we are going to what? And purchases is part of our cost of sales, so we are going to link it with that. So I'm going to have the closing balance divided by our cost of sales from our income statement and multiply that by 360 days. I have this. That is very huge. I'm going to format it as a 0 to the 0 decimal places, make it italic, and also format it or copy it to the right using Ctrl R. Okay. I'm going to do same for accrued expenses. Now, accrued expenses, as the name goes, is expenses. And so the most reasonable financial statement and income statement item you can attach it to, or we can use to model this, is our total operating expenses. This is a composition of different expenditure items. And it's difficult for us to trace the expenses to which these accrued expenses are relating to. And so to be on a safer side, we are going to use what? The total operating expenses. So I'm going to have this, the figure there, divided by our total operating or total cost of sales from the income statement, and multiply that by 360 and enter. Format this to 0 decimal places and also make it italic and copy it to the right using Ctrl R. And then finally, I have my unearned revenue days. This is going to be equal to our unearned revenue. Now, as the name goes, this is unearned revenue. Hence, it's going to be what? Modeled using our revenue, our total sales. So divided by my total sales, which is part of our income statement items. Total net sales here. And multiply the result by 360 days. So multiply by 360. And that is giving me that. I'm going to reduce the decimal places to 0 and italize this, or I make it italic using Ctrl I and copy it to the right using Ctrl R. Alright, so we are done with calculating the historical ratios of our working capital items. Now, as you can see, when I'm scrolling, I can't see whatever I'm working under, so I'm going to freeze the pins. So clicking on my current asset here, I can come to view, and then under the Windows area here, I'm going to have freeze panes, select the drop down and freeze panes. So that is what I want to do there. Alright, now that we have calculated our historical data, we are going to go ahead and do our modeling. So we are going to look at the historical trend of these ratios and make reasonable assumptions going forward. So for inventory turnover days, we can see that this has been 43 in 2021 and 2022 actual years, and reducing to 39 days within 2023. So reasonably, we can say that this 39 is going to continue going forward. So what I'm going to do is to select this 39 and copy this to the right using Control R. So I'm going to assume that this is going to continue to the rest of the periods. Alright. Then for our accounts receivable days, this has been increasing over the period. Alright, so once again, you're going to assume that it's going to continue from the last period. So I will have this, make it italic, and also copy it to the right using Control R. Then we also have accounts payable days. Now for accounts payable days, this has been fluctuating over the period, so from 104 days to 99 days to 100 days. So what I'm going to do is to find the average because they are revolving around the 100 point. So I'm going to have average of this. So I'm going to have equals average. Sorry. So I'm going to have equals average. Use my tab key to select that. And I'm going to select all of these three items here. Close my parentheses and hit enter. So that is 101 days. I'm going to copy this to the right using Control R and also make it italic. Then for my accrued expenses, this has also been changing. So from 68 days to 78, then back to 76. So I can assume that this 76 is going to continue for the rest of our period. So I'm going to have this copied across 76, and then I can make that italic. For an earned revenue, which is the final current liability item, it has been 9, 9, and 10. So I'm going to find average of that and see what is going to be. So the average is 9. I'm going to copy this to the right using Control R and also italize that or make it italic. Alright. Okay, so now that we have made assumptions for our ratios, we can go ahead and calculate the estimates of these assets and liabilities. So for my inventory, what we do is to change the formula we have previously used for our historical dates. So when you look at the formula, it is the item balance divided by our income statement item, and we multiply the result by 360 days. Now, when it comes to the projection, this is going to be equal to, for inventory days, is going to be our inventory turnover days estimate divided by 365 days multiplied by our cost of sales. As you can see, we are just changing the formula to obtain. Now, this cost of sales is the estimate cost of sales or the forecast cost of sales. All right, so this particular amount here. So I'll hit enter, and that is giving me 38,585. I can now copy this across using Control R. Okay. Then for my accounts receivable, is going to be the accounts receivable days estimate, which is 33, divided by 60 days, multiplied by my total net sales from the income statement. So total net sales for 2024 estimate, that is here. Enter that, and copy my formula to the right using Control R, and also reduce the number of 0 to 0. All right. So that is it about that. Then for our accounts payable, it's going to follow the same trend. is going to be my accounts payable days divided by 360 days multiplied by my cost of sales from the income statement estimate. So the estimate cost of sales here, I'm going to select that and hit enter. Reduce my decimal place number of decimal places to 0 and copy this to the right using Control R. Now I can see that some of my figures have changed, so I'm going to anchor this particular formula. So to anchor that, I'll hit F4 for my first selection and here, and also hit F4 to anchor that. Later, I'll show you how to do anchorage in Microsoft Excel in a special video, so look out for that particular video. So I'm going to copy this to the right using Control R. All right. Then for my accrued expenses, it follows the same trend as well. So you're going to have my accrued expenses days divided by 365 days multiplied by my account, my total operating expenses from the income statement. Estimate here, so I'm going to pick the estimate there and hit enter. All right, so I think I've made a mistake here. I'm sure you have already identified that. So this is actually supposed to be row 31. All right, this is supposed to be row 31, so I can copy this to the right using Control R. So I have that corrected. All right. Right, so I'm going to reduce the decimal places to 0 for that and also copy my formula to the right using Control R. Then lastly, I'm going to have my an end revenue forecast, which is going to be the end revenue days divided by 360 days multiplied by my total revenue estimate for 2024. So I can scroll this up and select this and hit enter. And then I can reduce this also and copy it to the right using Control R. So that is what we've got there. All right, now that we have estimated our working capital items, we are going to have our total operating working capital. So I'm going to have total operating working capital, and that is going to be equal to the, okay, so before that, let's calculate the individual totals first. So I'm going to have equals this plus this. Copy the formula to the right using Control R. Then I'm also going to bolden this using Control B and also insert border there. So a top border including here. All right, and then also I'm going to have my total for my current liabilities as well. So before that, let me insert my border there and also bolden that. So this is going to be equal to accounts payable plus my accrued expenses plus my unearned revenue. I have that. I can copy this to the right using Control R. and increase this a little and this one to a little. Okay, so now that we have everything here, we can now calculate our total operating working capital, and that is going to be equal to our total current assets minus the total liabilities or total current liabilities. So I have that. I can copy this to the right using Control R. As you can see, in all cases, the total current liabilities are more than the total current assets. And so this business is very illiquid, all right? It might have liquidity challenges. All right, so now let's go to our statement of cash flows and complete the working capital items changes in operating section. All right, so let me also freeze the panes here. So selecting here or here, I can go to my view tab, come to freeze panes and freeze the panes. So that when I'm scrolling down, I know the year under which I'm working. All right, so the first item, as we are already aware, is inventory. So inventory, changes in inventory. When it comes to changes in working capital items within the statement of cash flows, we are particularly looking at the effect of changes in these items on our cash flow position. So when inventories are increasing or decreasing, what is the effect of this on our cash flow statement? When accounts payables are increasing or decreasing, what is the effect on our cash position? That is what we are looking at when it comes to changes in operating assets and liabilities. Now, this is different from ratios analysis. All right, take note of that. All right, so the first item is our inventory. Now, let's look at inventories. What happens when your inventory amount increases from, say, 10,000 or 1,000 to 3,000 at the end of the period? At the beginning of the period is $1,000. At the end of the period is 3,000. Now, when your inventory increases from 1,000 at the beginning of the period to 3,000 at the end of the period, what this means is that our inventory at the end of the period, which is 3,000, have not been sold. All right, these are remaining in store. Because they're remaining in store, we call it cash being locked up in store or in stock. All right, so that is what we describe this situation. And so whenever our inventory figure increases over the period, it means that we have not sold our inventories for cash, and so our cash position has reduced as a result of the increment in the inventory. All right, so when it comes to the effect of changes in inventory, an increment in inventory and as such our current assets actually means that our cash flow position is coming down, or our cash resources are being dwindled or drained. All right, and the opposite is true for our current liability items. All right, so let's look at the changes in these items and then another video. In the next video, we are going to look at the balance sheet. Okay, how to forecast the balance sheet. All right, so we are going to have equals. We come back to our working capital schedule, and then for my inventory, I'll have minus so I have equals minus, then come to my working capital schedule, and this is going to be equal to the 2024 working capital estimate right here minus my (2023) one here, and then I'm going to put it in brackets. So I'm going to have brackets there and hit enter. and reduce the decimal places to 0, and also format this as an accounting figure with 0 decimal places, and copy this to the right using Ctrl R. Right. Then we also have account receivables. So this is also going to follow the same trend. This is going to be minus. Now we are putting minus there because we are bringing minus because looking at these items generally, they are increasing over time. And whenever these current asset items are increasing, an increase in current assets has a negative effect on our cash. That is why we are inputting the negative sign before calculating the difference. All right, so that we know that this negative is what we are saying is having an opposite effect on our income statement. So I'm going to delete this. Minus the 2023 item there, close my parentheses and hit enter. So I'm going to format this as an accounting figure by inserting a comma with 0 decimal places, and also copy this to the right using Ctrl R. Now Amazon has classified other assets as a working capital item, which is very ambiguous because the other assets which are found within the balance sheet is actually classified under the non-current assets, which is not under current assets. And so including that within our cash flow statement as a working capital is not very clear. And so what I'm going to do is to put 0 here as our estimates. So I'm going to put 0 there and copy that to the right using Ctrl R there. Okay. Then we have accounts payable. So for accounts payable, let's go to our working capital schedule and look at the items on face value. When you look at the items at face value, you could say that they are also been increasing over time. Accounts payable, accrued expenses have been increasing over time. All of the items have been increasing over time. And so as a practice, what we do is that for current liabilities, whenever they are increasing, it means that we are not paying our liabilities. And so the amount we are using or we are supposed to use to pay off these liabilities which are becoming due, we are holding on to those amounts or those funds. And so this will naturally increase our cash position. All right, so that is what we are doing here. So unlike the current liabilities where you are flipping the sign, this one you are going to difference. And so this is going to be equal to, come to my working capital schedule and select my accounts payable for 2024, and this is the difference. So I'm going to insert that and reduce my decimals to 0 and copy this to the right using Ctrl R. I'm going to do the same for my accrued expenses as well. These are expenditure items and they have been increasing over time, and so it means we are holding on to our cash. Okay, so we have this minus this one as well, and then format as an accounting figure with 0 decimal places and copy this to the right using Ctrl R. And finally, an end revenue. So I'm going to have my end revenue there, which is going to be this minus 2023 figure there, enter, and I'm going to format it as an accounting figure with 0 decimal places, and I can copy to the right using Ctrl R. So just like that, we are able to complete this particular portion of the cash flow statement as well. All right, so we are doing great. In my next video, we are going to look at our balance sheet and forecast the balance sheet items as well. Alright, so thank you very much for your time in this particular video. If you are not subscribed to the channel, please make sure you have subscribed to the channel so you don't miss any of my videos when I get them posted. Alright, so I'll see you in the next video.